So let's go ahead and use our formulas on an example trade. Now this trade is actually going to be part of your workbook, so follow along and see if your answers tie off to what mine do. If they don't, pause the video and see where you went wrong. Our example trade is going to be looking at Facebook, which there's the ticker in the upper left. This is going to be a trade date of January 22nd, 2018. And I'm bullish on the stock, so I'm interested in the March call spread. And this is going to be the 185, 195 call. So how do I put this trade together? Well, I'm going to buy one of the March 185 calls, and I'm going to pay $7.75. Simultaneously, I'm going to sell one of the March 195 calls for $3.45. Now, what's really interesting here is if you look at this chart here, these candlesticks are actually looking at the Facebook chart. So that's the stock, okay? Stock is kind of trending higher. I think the stock is going to continue to go higher, so I'm putting on this spread. This light-colored line here is actually tracking the P&L of how our spread is going. You'll notice Facebook actually goes up right around this point, and you'll notice this light-colored line, as expected, went up as well. So the stock is going up. My bull call spread is worth more money. You'll then notice that Facebook took a dive. What do you think is going to happen to my bull call spread? Well, it's actually going to start losing money. That's this light-colored line that fell. And you'll also look over here to the left that we're starting to lose money. Facebook never really got anywhere north 185 at expiration. Therefore, I didn't make money on this call spread. And you can see this line here is in the negative. So let's take a look at the max loss and the max gain. So Facebook's at 185.37. It's January 22nd, 2018. I'm bullish on the stock out to March expiration. Let's go ahead and calculate our max loss. So we're going to take the premium that we spent on the 185 call of $7.75. Then we're going to subtract the premium that we received on the 195 call of $3.45. That equals $4.30. Remember, we're doing the structure one time, and you have to multiply times 100. 100 multiplier. Your max loss then is $430. So no matter what, the most that I can lose by putting this trade on is $430. So now let's go ahead and calculate our max gain. So you're going to take the difference in the strikes. So 195 minus 185, those are our call strikes. And then you're going to subtract the net premium that you spent, which also happens to be your max loss. That is going to give us 570. We're doing the structure one time, and then you're going to multiply times 100 shares of stock, and your max gain is $570. That's the most that I can make on this spread. So let's go ahead and calculate our break-evens and then the net result. So the break-even is simply going to be your lower strike, which is the 185 call, plus the net premium that you spent, $430. That equals $189.30. Facebook needs to be above $189.30 for me to break even at expiration. Facebook price at expiration is $185.09. So let's go ahead and calculate the net result. So the way that you're going to do this is you're going to have to look at the P&L of both of the calls. So let's go ahead and calculate our net result. And to do that, we have to look at the P&L of both call legs. So let's go ahead and start with the 185 call. Now remember, we paid $7.75 for this call, and Facebook expired at 185.09. So there is 9 cents of intrinsic value in that call. So for this call, we had a loss of $7.66. The 195 call, remember, we sold that for $3.45. That's going to expire worthless, so we're going to keep all of that. We're going to sum these numbers together, and you're going to get a negative 421. Now remember, you did this spread one time, and it's a 100 multiplier, so your net result is a negative $421. You lost money is the net result. So let's go ahead and review the bull call spread. Remember, you need the stock to pop in order for this spread to make money. So adapt the vertical bull call debit spread to your hypothesis. There needs to be an upside catalyst for your stock in order for this setup to actually make money. The good news is you can assess the outcome of applying this spread to your strategy. You can calculate your break even, you can calculate your max loss, your max gain, all at the beginning, so you know what to expect no matter what the outcome.